Hello, this is David Chitty from Crow Horwath International. In this presentation, I'm going to give a short introduction to IFRS 9 financial instruments. The objective of the presentation is to give an overview of the key features of the standard and to help you prepare for implementing this demanding standard. IFRS 9 was developed by the International Accounting Standards Board, the IASB, as a project to replace IAS 39. The completed version of IFRS 9 was issued in July 2014 after a very extensive process for developing the standard, and this completed version of IFRS 9 has an effective date of accounting periods commencing on or after the 1st of January 2018. Now, this date is important because next year, 2017, is the comparative year, and therefore companies do need to start thinking about what they have to do to implement the standard. IFRS 9 sets out the requirements for recognising and measuring financial assets, financial liabilities, and some contracts to buy or sell non-financial items. The standard itself covers the following areas: classification and measurement, an impairment methodology, and hedge accounting. In this short presentation, I shall introduce the principles for classification and measurement, for the impairment methodology, and for hedge accounting. Beginning with classification measurement, IFRS 9 requires an entity to recognise a financial asset or a financial liability in its statement of financial position when it becomes a party to the contractual provisions of the instrument. And that's the important point to focus on, is the contractual provisions, and as a result of the contractual provisions is recognition required. There's a lot in the standard and its supporting guidance about understanding the contractual provisions. At the point of initial recognition, an entity measures a financial asset or a financial liability at its fair value, plus or minus, in the case of a financial asset or financial liability, not at fair value through profit or loss, transactions costs that are directly attributable to the acquisition or issue of the financial asset or financial liability. The key point here is initial recognition is at fair value. We then have this adjustment factor to consider. Moving on to focusing on financial assets, when an entity first recognises a financial asset, it classifies it based upon its business model for managing the assets and the asset's contractual cash flow characteristics. Again, there's more in the standard about this, but this is guiding us as to how to classify a financial asset. A financial asset is measured at amortized cost if the two conditions here are met. The asset is held within a business model whose objective is to hold assets in order to collect contractual cash flows, and the contractual cash flows of the financial asset give rise on specified dates to cash flows that are solely payments of principal and interest on the principal amount outstanding. However, an entity may, at initial recognition, irrevocably designate a financial asset as measured at fair value through profit or loss if doing so eliminates or significantly reduces a measurement or recognition inconsistency. That's sometimes called an accounting mismatch that should otherwise arise from measuring assets or liabilities or recognizing the gains or losses on them on different bases. So this addresses an accounting mismatch issue and helps with the application of the standard. The general rule, however, is that a financial asset is measured at fair value unless it is measured at amortized cost. When and only when an entity changes its business model, financial assets, it must reclassify all affected financial assets. So the rule, fair value unless measured at amortized cost, and a remeasurement, a reclassification only arises if the business model for managing financial assets is changed. The IASB has made limited amendments to the requirements in IFRS9 for the classification and measurement of financial assets. These amendments were made to address a narrow range of application questions and introduced a measurement category, fair value through other comprehensive income for particular simple debt instruments. This measurement category was introduced in response to feedback, including insurance companies, as this was the most relevant measurement basis for financial assets that are held within a business model whose objective is achieved by both collecting contractual cash flows and selling financial assets. Moving on to financial liabilities, an entity classifies all financial liabilities as subsequently measured at amortized cost using the effective interest method, except financial liabilities at fair value through profit or loss. Such liabilities, including derivatives that are liabilities, are subsequently measured at fair value. Financial liabilities that arise when the transfer of the financial asset does not qualify for derecognition or when the continuing involvement approach applies. Financial guarantee contracts for which special accounting is prescribed, and commitments to provide a loan at below market interest rate for which, again, special accounting is prescribed. However, an entity may, at initial recognition, irrevocably designate a financial liability as measured at fair value through profit or loss when permitted, or when doing so results in more relevant information. After initial recognition, an entity cannot reclassify any financial liability. Impairment. The impairment requirements relate to the accounting for an entity's expected credit losses on its financial assets and commitments to extend credit. These requirements eliminate the threshold that was in IAS 39 for the recognition of credit losses. Under the impairment approach in IFRS 9, it is no longer necessary for a credit event to have occurred before credit losses are recognised. Instead, an entity always accounts for expected credit losses and changes in those expected credit losses. The amount of expected credit losses is updated at each reporting date to reflect changes in credit risk since initial recognition, and consequently, more timely information is provided about expected credit losses. The impairment requirements, the requirements related to expected credit losses, are an important area to consider in the implementation of the standard. And hedge accounting, the requirements related to hedge accounting align hedge accounting more closely with risk management, establish a more principle-based approach to hedge accounting, and address inconsistencies and weaknesses in the hedge accounting model in IAS 39. And in its discussion of these general hedge accounting requirements, it should be noted that the IASB did not address specific accounting for open portfolios or macro hedging. The IASB has produced a discussion paper addressing issues concerning macro hedging, and therefore the exception in IAS 39 for a fair value hedge of an interest rate exposure of a portfolio of financial assets or financial liabilities continues to apply. The IASB has also provided entities with an accounting policy choice between applying the hedge accounting requirements of IFRS 9 or continuing to apply the existing hedge accounting requirements in IAS 39 for all hedge accounting, because it has not yet completed its project on the accounting for macro hedging. This presentation is intended to be a brief overview of IFRS 9. It's a detailed and important standard. It's important for users to go beyond what we've covered in this presentation and look at the detail in the standard and supporting guidance. And it's important to start working now on implementing this standard, as it'll be effective for 2018 year ends. Thank you for listening to this presentation.